one of the narratives that's going on by Wall Street right now, we're going to have a reacceleration of economic activity next year. This slowdown that we're having right now, this is the fabled soft landing in the economy. So we've seen weak employment data, we've seen weak consumption data, et cetera, but somehow that's going to turn the corner here. Things are going to get better fairly quickly. This chart is actual earnings and then forward-looking earnings growth. So the blue bars are the Mag 7 and the green bars are the S&P 493. Over the last 2 years, there's been very little growth in the bottom 493 stocks. Most of the growth in earnings has come from the Mag 7. Now what analysts think going into next year, the earnings growth will all come from the 493 and earnings growth will slow for the Mag 7. My question is if it hasn't happened in the last 2 years where you had this massively strong economic growth because of stimulus payments, because of all this money from the Inflation Reduction Act, the CHIPS Act, all those type of things, what's going to be your driver next year? Because you don't have any of those supports. Where's this earnings growth going to come from? Because it has to come from economic activity. So you have to be betting on a fairly strong recovery in economic activity to support that. It has to come from earnings activity because that's what creates the revenue, particularly for the bottom 493 stocks. Let's take a look at a few economic indicators to see if we can kind of derive what might actually occur next year. So this is the leading economic index. So this is the 6-month rate of change. It has a long history of being a very strong economic cycle indicator, except this time. We've had a very negative leading economic index for a couple of years now, no recession. So does that mean it's just inevitably wrong and flawed? No, because there are some things that were occurring because of the pandemic that just shoved trillions of dollars of money into the economy, which kept the economy going, even though the other factors in the economy that impact the leading economic index suggested there was a recession, but we didn't have a recession, right? Because employment remained stable, et cetera. That 6-month rate of change has now turned lower. So over the last 6 months, the leading economic index has begun to weaken again, still in negative territory. That recent downturn of the last 6 months certainly doesn't augur for a much stronger rebound in economic activity in the next 6 months. I'm just saying it's something we have to consider. Maybe the expectations for a resurgence of economic growth may be a bit ahead of themselves. The other is the inverted yield curve. It has a very long track record of forecasting economic downturns. It's not the inversion of the yield curve that is the recessionary indicator. So this is one of the traps that people kind of get into is like, oh, the yield curve's inverted. That means we're about to have a recession. It's when the yield curve uninverts that your potential for a recession increases dramatically. It's the uninversion of the yield curve when it goes from red back to blue. That's when the recession actually kind of sets into place. That yield curve has uninverted, but we don't have a recession yet. Does it mean we won't this time?
Catch me daily on The Real Investment Show. The link is in the description.